All right, welcome to Talking Investing. I am Tom, and as always, this is not financial advice. Today, I want to update the stock market overall. I want to talk about what happened yesterday, and most of all, I just want to take a time out because there was definitely, in my opinion, a massive panic yesterday, which I don't think there was any reason for. So I'm going to go through that. I want to go through a few charts that show you, despite the fact that yesterday was a train wreck, we really stayed above some critical lines of support. So these market updates are something I want to add to the channel. They're not my normal videos, so if you could do me a favor and smash the like button, it helps get this out to more people, and I'm trying to get these videos out to more people. So I'm shooting for 200 likes. We didn't quite get there last time, but that's okay, so let's see if we can get there this time. I appreciate your help and all of your support with your likes and comments and everything. So, okay, let's talk about the stock market. This morning right now, if you take a look, you'll see we're up a little bit across the board, and that is to be expected. We'll see if that holds, but right now the S&P is up about 0.3, the Dow's up about 0.2, the Nasdaq's up about 0.4, and the Russell's actually down about 0.28. So mostly green day today, so a little bit of a recovery after what I think was an absolute full-blown panic attack yesterday. And I'm going to go through some of the numbers and show you why I think that. And I don't think it matters so much where we land at the end of the day today, as long as there's not a dramatic move today. So if this turns dramatically red, then I may start to look at this in a different light. You know, if we're down 1 or 2 or 3% again today, then I think we will break some important lines of support. But right now, that's not what's happening. So I don't want to worry about what if. Right now, I just want to look at what is. So I'm just going to show you a chart I put together regarding yesterday, and I don't want to belabor it too much, but I just want to show you what kind of overreaction this was, in my opinion. Now, yesterday was the worst trading day for equities that we've had in over 2 years. Now, you guys know how bad the last year has been, particularly the last 8 or 9 months. So with all of that negative pressure over the last year, yesterday was the worst day out of all of them. So again, to me, that was a reaction to the CPI data. The CPI data came in a little bit worse than expected, but it certainly should not have been a shock to anybody where those numbers came in. So yeah, we wished it was a little bit lower, but for that to result in the worst day in 2 years, to me, was a massive overreaction. I actually expected a negative knee-jerk reaction, but not that. This is what happened to some of the larger cap companies yesterday. So these numbers are staggering to me. I'm going to start at the very top of the list. So what this is measuring is, this is how much market cap these companies lost just yesterday, and this is measured in billions. So in other words, Apple yesterday lost $154 billion of market cap in 1 day. So that is bigger than almost every single company in the entire stock market. So that's what they lost in 1 day yesterday, in 1 day of trading. So I can't understand a day, nothing Apple specific even happened yesterday. Amazon was down 98 billion, almost $100 billion. And again, nothing Amazon specific happened yesterday. None of the stocks on this board had any news yesterday that was specific to them. This was all just negative downward pressure based on a CPI report that came in not quite where we expected it to. Microsoft, which is the most stable company I know, that was down $49 billion in 1 day. Bitcoin, and this I measured from the high to the low yesterday, so in total, from the high to the low, Bitcoin was down $49 billion. Meta, which is Facebook, was down $43 billion. So you can see these numbers get smaller and smaller, but let's put things in perspective. Costco's at the bottom of this list. They lost $13 billion in 1 day. So that starts to not seem like a lot when Apple lost $154 billion. But for those of you who watch the channel, you know that we cover Bitcoin and the Bitcoin miners quite a bit. And if I compare that to all of the publicly traded Bitcoin miners put together, that's almost 3 times as much money as all the Bitcoin miners put together. So Costco lost that in just 1 day. For two companies to be at or over $100 billion loss of market cap in 1 day, and then another couple at, in the neighborhood of 50 billion. So again, we have to see where we go from here, but you can see yesterday was a massive move to the downside. Yet, with all of this incredibly negative action, what I want to do is look at the charts that we've been looking at on this channel, because I think they're going to show a different story. This looks like a disaster. But let's go to the S&P 500 or the SPY. Okay, so this is the SPY on the 4-hour time frame. This basically mirrors the S&P 500. So you can see we've had an ascending line of support on here that dates all the way back to June 17th. So yesterday, even with that massive downward move, over 4% to the downside in 1 day, you can see we bounced right off of support. So we candle wicked right into this line of support, and this support held, and it's holding right now today. To me, this is why I want to call a timeout and just look at what's going on. Like, yeah, yesterday was a bad day, but it was not a breakout. We didn't break out to the downside. And it's actually fairly encouraging to bounce off of a line of support. You know, we obviously had a giant relief rally here. This yellow arrow was a 2-month relief rally. Well, we had a very big pullback, and we bounced off of this line of support. We had a nice rally for a week, but unfortunately the CPI numbers absolutely freaked everybody out yesterday. So yes, we went back and tested this line of support again, but we're still above where we were last week. Okay, here we go. This is basically the identical setup. So this is QQQ. This mirrors the Nasdaq. So this was almost 24% from the bottom to the top over a 2-month period. So that was a very nice relief rally. But yes, we did pull back. We spent a week or two, we pulled back, we hit this line of support, bounced right off of it. Then we had a giant week of just green candle after green candle after green candle. Everybody was expecting the CPI numbers to be good, better than expected, and that did not happen. In fact, the opposite happened. They were a little bit worse than expected, but let's not get carried away. The headline number still did go down from 8.5 to 8.3. Now, the core number went up, and a lot of things were moving, not nearly in the direction that we hoped they were, but the report was not a disaster. I did do a separate video on that report yesterday, so if you want to check out the details of what happened with the CPI report, you can check that out on the channel. But here again, on the Qs, you're going to see we bounced right off of this line of support at the close yesterday, and here we are at the open, and we are still above this line. Until we see a confirmed breakout below this line of support, I'm not going to get ahead of myself. Bouncing off of line of support is usually, by and large, a good time to consider taking a look at your watch list and see if anything has entered into a buy zone. So that is what I've been doing. I don't go all in. I dollar cost average in, and I try to be very careful, right? You don't want to spend all your money in one day. You always want to have some money on the sidelines if possible, but these are the opportunities that we look for. So when we get a big pullback like this is when I start to do my dollar cost averaging in. So again, this is not financial advice. I can't tell you guys when to buy stocks and sell stocks, but I do want to show you these charts that I'm looking at and put this situation into a little bit of perspective, because if you just look at yesterday alone in a vacuum, it seems like the market crashed and the sky is falling. But I don't feel like that's what the charts themselves are showing us. I want to go to the VIX because this is important too. This is the VIX. This measures the volatility of the S&P 500. So you can see I have a few lines on here. I have a green line down here. Between 15 and 20 is healthy for the VIX. You can see I have a blue line up here, and that's at around 35. So historically speaking, when we get up to 35 on the VIX, that is when the market is starting to panic. And that has happened. Obviously, it's been a bad year. So this is the chart. This goes back to December of 2021. You'll see we've hit 35, 1, 2, 3, 4, basically 5, 6, 7 times. So it's not like we don't get to this. This has been a very bad year, and we have gotten to this level of volatility 7 times. But you can see yesterday was not one of those days at all. Yes, we did have a giant leap in volatility, so we had a very big green candle, but we only got ourselves up to about 27. So that is nowhere near the panic zone. And you can see we're leveling off today. We are down off of yesterday's high. We got up to a high of 28 on the VIX yesterday. Right now, we're at about 26.77. So that is dropping down. So that is not a range yet to be panicked about. So this is another indicator that, yes, yesterday was a bad day, but it does not look like we've changed directions and we're in a panic. Last thing I want to look at is the DXY. This is the dollar. So the dollar has been unreasonably strong. And when the dollar is this strong, historically strong, it does tend to hurt the equity markets. It definitely hurts the cryptocurrency world. And we've had a historic run up in the dollar. So the DXY, this line right here, this green line at 103, we've touched this line several times, but that is a 20-year line. That goes back to the year 2002. So while we have touched that a few times in that 20 years, we have not gone above it until now. So you can see in May we went above that, we pulled back below, and now we're considerably above that. We hit an all-time high, about a week ago, just under 111. So again, the previous 20-year all-time high was just under 104. This was trending in the right direction. You can see we had 1, 2, 3, 4 red candles in a row where this was starting to pull back, and we were seeing simultaneous with each one of these red candles for the dollar, we were seeing green candles on all the indexes. We were seeing green candles on all the cryptocurrencies. We jumped all the way back up to 110 yesterday, so we did not get back to our highs from last week, but that was a big jump. So we do have a red candle working today, and again, it's early in the day. We'll see what happens, but over time, I imagine that this index is going to get back down to this line. This is a 20-year line. So I would look for the dollar sometime, I don't know if that's going to be 30, 60, 90 days from now, but I would think it would gravitate back to that line, and that's when the overall market should start getting healthier. If the charts tell me that this line is broken, then it's time to reassess, but right now we're just simply bouncing off of support. So I don't like to get ahead of myself. I don't want to anticipate that we're going to break this line. If we break it, we'll reassess. So I will probably do a market update tomorrow and see how this all played out. But for me, I took this as a little bit of a buying opportunity. Again, this is not financial advice. Please be careful investing in this environment and do your own due diligence. But those are my thoughts on the market overall, and particularly on what I think was an overreaction yesterday. So let me know your thoughts in the comments below. And again, if you're new to the channel, please remember to subscribe and also smash the like button. So thanks again for watching. We'll see you in the next video.